If you're planning to buy a home in Ontario with less than 20% down payment, there's something important that you need to know about, and that is mortgage default insurance. This cost can sometimes catch buyers by surprise as it does play a key role in getting you into homeownership sooner. So let's break it down. Mortgage default insurance is paid by the buyer. However, it protects the lender, not the buyer. Even so, it is still a good thing. This insurance allows banks to lend to buyers with smaller down payments by reducing their risk because they are now protected by this insurance. In Canada, there are three major providers of mortgage default insurance, and those include Canada Mortgage and Housing Corporation, otherwise known as CMHC, Sagen, formerly Genworth Canada, and Canada Guaranty. Lenders typically arrange this insurance on your behalf, but remember the cost is paid by you, the buyer. The exact cost of mortgage default insurance will depend on your down payment. The smaller your down payment, the higher the premium. Here's a quick breakdown. If your down payment is 5% to 9.99%, the premium is 4% of your mortgage amount. If your down payment is 10% to 14.99%, the premium is 3.1% of your mortgage amount. And if your down payment is 15% to 19.99%, the premium is 2.8% of your mortgage amount. To further clarify, let's look at an example. If you're buying a $700,000 home with a 10% down payment equaling $70,000, your mortgage would be $630,000 and your insurance premium would be $19,530, which is then added to the cost of your mortgage. So no, this isn't a lump sum of money that you're going to have to pay, but it does make your mortgage higher. In this example, instead of borrowing just $630,000, you'll actually be borrowing $649,530. There are also a couple restrictions to obtaining this insurance. Number one, your total purchase price must be less than $1.5 million. Anything above that amount automatically requires 20% down payment. And number two, this only applies to owner-occupied properties. If you buy an investment property, you are also required to put down a minimum of 20%. So yes, there is an extra cost here, but the advantage is that the insurance helps more Canadians buy homes with smaller down payments. In addition, since lenders are protected, they can offer lower mortgage rates on those products, which saves you money over time. And the final thing I want to point out is that there will be PST on this insurance, and that means that a cost equal to 8% of the mortgage default insurance premium will be owed. And this tax can't be added to your mortgage. Instead, it is a lump sum due on closing. So while mortgage default insurance may seem like just another cost, it's actually helping you get into the market faster. So if you're buying with less than 20% down, factor this cost into your budget so that there are no surprises.